And so today I'll be speaking about the Seilern funds, and more specifically about our American strategy, Seilern America, which I'm also the portfolio manager, the lead portfolio manager of. And you'll see that we have three funds, and they're all following the same philosophy. I'll explain that. And so when I speak about the American philosophy and strategy, I'm really speaking equally about all of our various strategies. So I'll speak a little bit about the company first, just in a few words, present to you as Seilern Investment Management. And then I'll explain first the philosophy that we follow for the American strategy and the other funds. And then the investment process that we follow, where we actually spent a lot of time to work on that process. And we think it's a very important part about how we do things and how we operate for you to understand. So to start with Seilern Investment Management, it was founded in 1989 by Peter Seilern, who's currently the chairman and the CIO, the Chief Investment Officer of the company. Seilern is 30 years old, 31 years old to be exact. And throughout that period, we've always followed the very same investment philosophy, which is a philosophy we call quality growth. We apply it to all of our funds. And so we have an American fund, a European fund, and a global fund. But the focus today is about the American strategy. We are an independent firm in a couple of ways. So first of all, the research is proprietary. It's internal to the company. And the research team basically does all of its research in-house, and it's really the core of what we do. And the second aspect is we're independent in the sense that the company is owned by both the employees and the family who founded the company, and mostly Peter Seilern. Finally, we invest with conviction. So we hold portfolios. All of our portfolios are UCITS funds. And in that sense, they have a minimum for concentration purposes of 17 stocks and a maximum of 25 stocks. That's the limit we've set to make sure that we don't dilute the quality of the companies that we invest in. So we want to make sure we know our businesses well, and we invest in the best businesses possible. So we concentrate the fund to a maximum of 25 positions to invest in those. So that's the company in a few words. And I'll jump now into the quality growth philosophy, which I mentioned. And this philosophy is based on a fairly simple principle, which is really our belief that in the long run on the stock market, the stock price of a company will follow the earnings that the company generates, the earnings growth of that company. It's not true, of course, in the short term. Many things will impact the stock prices, which don't have anything to do with the earnings growth. But in the long run, we strongly believe that earnings growth drive share prices. And so on that front, we look for two things. First, we want to invest in the long run to capture that earnings growth in the share price. And second thing, we want to find companies that can grow their earnings in the most predictable way possible, in the most sustainable way possible, to meet that investment horizon. So our investment horizon is usually 5 to 10 years, and sometimes we're invested for longer than that. So that's kind of the principles behind the philosophy. And on the next slide, you have the 10 golden rules. So these rules are very important because every company that we invest in and every company that is part of our Seilern universe, which I'll explain later, has to comply with each and every one of these 10 golden rules. So it's a very useful way for us to explain to our investors what we look for in a company, what types of businesses we invest in our American fund. So going through these rules, so there's two buckets is how we split these 10 rules. We have the growth ones at the top and the quality ones, or the risk management one, if you want, at the bottom. Going through them very briefly, we're looking for industries which have secular growth drivers, so which can grow above GDP and for the longer the better. We look then for the leaders within those industries, so that can be the largest player, number one, number two. That can also be sometimes smaller players which are just better positioned to capture the growth. We're just looking for the best positioned companies to capture the growth in that industry. And we're looking for scalable business models. So that's kind of self-explanatory, but and common sense, like most of these rules are. But it's the idea as well that we're looking for businesses which are already highly profitable, already generating a lot of high returns and strong free cash flows, and that can grow and scale up by using their own profits and cash flows, basically. So can finance their own growth without external financing. Then we look for a sustainable competitive advantage. I'm sure you've heard that many, many times. But it's very easy to find a competitive advantage, especially for large cap businesses that we invest in. It's harder to decide whether that's sustainable for the next 5 to 10 years. And that's where we as a team, we spend most of our time debating and discussing, sometimes in tough debates, whether the competitive advantage of such and so a company are sustainable for the next 5, 10 years, or even strengthening. And that's really what we're looking for, and we'll spend a lot of time on that. And finally, strong organic growth is the idea that earnings growth can come in many forms, but will favor organic revenue growth, which is the most sustainable growth, if you want, compared to cost cutting, for example, which is often not very sustainable, or M&A. So we're wary of M&A, which comes with a lot of risk. So we have a lot of strategies with a little bit of M&A, bolt-on M&A for many of our companies, but we avoid large M&A or growth that depends too much on M&A because it comes with a lot of risks always. And then on the qualitative rules, we're looking for a customer diversification as much as possible and a wider geographic exposure. I mean, that's, again, common sense for risk management purposes. We don't want any of our businesses to depend too much on a large customer. It's not good for pricing. It's not good for risk. We favor capital light businesses. First, because that means usually they have high return on invested capital. That's the best way to compound growth for the long run and to create value. Second, because we look for non-cyclical businesses as much as possible. So we avoid capital intensive industries, which are often quite cyclical. And third, also because these companies tend to leverage and finance their growth often at the worst possible times at the top of cycles with debt. And this is the third rule, solid financial position. We are very wary of debt and we avoid leverage as much as possible. In fact, all of these rules are qualitative rules, but there's one quantitative rule which we have about leverage, which is that we never invest in a business with more than 2.5 times net debt to EBITDA, so 2.5 times net debt to EBITDA. That's a hard rule. Any company going above that will exit the funds, and then we'll monitor it in the universe. If it's a short-term breach, we can reinvest later. If it's structural, we'll exit the company as entirely. I mean, we want to invest again in the company. So we are very averse to leverage into debt. Then transparent accounts is just the idea. So accounts are never fully transparent for large cap businesses, but we look as much as possible for businesses that don't have complex balance sheets and don't have a lot of long-term liabilities on their balance sheets, which are very hard to study and to analyze and to risk assess, if you want. And then finally, excellent management and governance. So we're looking for the track record of management, and more importantly, the incentives of management, making sure that they're like us, they're interested in running the business for the next 5 to 10 years or the long run. They're not trying to push the share price or anything in the short term. And so that they have the right incentives and the right governance structure so that there's not too much power in the hands of a few at the top of the company, so that all the checks and balances are there as much as possible. So these are the 10 golden rules, and every business that we own and invest in needs to comply with all of these. So that's very important that explains and summarizes the philosophy very well. And I guess just to finish about the philosophy, the main consequence of these rules is that we have a strong sector bias within the funds. And that's very important for our clients to understand. It's that we will avoid many sectors which are listed on the right-hand side for the reasons I listed before. So utilities and telecom, because we think they're GDP grower. Commodities, oil and gas, because they're price takers and not price makers. So they're too difficult to forecast or to predict. They're unpredictable. Heavy industrials for the capital intensive reasons I've mentioned, and the leverage and the cyclicality, and then banks and insurance for the transparent accounting and difficulty in understanding what's on the balance sheet, basically. So that means that in different markets will perform differently. In strong cyclical markets, will tend to underperform. Hasn't happened in this market yet, but 2005, 6, 7 was a good example. We should underperform in those times, and we won't change what we do, right? This is the philosophy, and this is how we invest. So there's a reason to underperform in these times, and if we outperform in these times, then you should check that we're doing things like we should. On the other hand, when there's a growth slowing down or growth is scarce, or there's even a recession, or in difficult times we're going through, the strategy tends to outperform because the companies are less cyclical than others. Their growth depends less on the cycle, and even more importantly, there's very little leverage. So the companies are never challenged in their financial position. So this explains the quality growth philosophy which we follow. And now I want to speak a little bit about the investment process. I've mentioned it's very important to us, and that's because we see it as a risk management tool. And yeah, the important thing to understand is that for us, the risk, we don't define it as being volatility, which is something that most investors do. That's because with a 5 to 10 year investment horizon, volatility is just short-term price movement, right? So if you're invested throughout the volatility, then what our real risk is that we don't invest in the right business, is that the company doesn't achieve its targets, doesn't generate the cash flows, or the competitive environment changes, regulation changes, something changes, and so we're not invested in the right business. So in that sense, we built an entire investment process around our universe, the Seilern universe. So it's a universe of 50 to 70 companies. 50 is a minimum to give us choice. So we're focusing on the US strategy. We have about 60 names in the universe, and about half of that are on the US front. The other half are European. So that means that we can choose on the American fund only out of 30 companies, which should be of very high quality and with large growth prospects. But that means we need to afford choice. 50 is a minimum to make sure we have choice across the funds. 70 is a maximum because we're currently 7 investment analysts, and we want to make sure we cover as much as 10 companies at most to be experts on our companies and to make sure we don't fall behind. We cover these companies very well. We're in touch with management. We're on top of the quarterly reports, and also we're all generalists, so we're covering competitors, different industries, and to be on top of all of that and do it well, we need to have a maximum of 10 companies. That's the limit we've set ourselves. So that's hence why the universe is the size it is currently, which is about 60 companies. The second aspect of the universe is that it's a quality control tool. So every company that sits on the universe has to meet a very high bar, if you want, of quality and growth. It has to meet all the 10 golden rules I mentioned, and it has to go through a unanimous decision of the entire investment team in order to be added to the universe. And I'll get back to that. But the point is, you go from 58,000 listed companies to a universe of 60 of the highest quality businesses we could find. And this is where, as a team, we'll add the most value. And if the universe is of high quality, then the funds will be of high quality because they can only pick from that. So that's the key message of how we run the funds and how we organize at Seilern Investment. We work very much as a team throughout that process, and I'll explain a little bit on the next slide better how we add a company to the universe. So we have an annual screening, and we go through 4 steps of exclusions, if you want, starting with the 58,000 listed companies I mentioned. We only invest in companies with a market cap above $3 billion, so mid-cap and large caps mostly. We only invest in OECD countries, just to follow the rule of law. And so that's largely the US and Europe, as well as a couple of Japanese companies. We exclude the industries, some of the industries that I mentioned earlier, such as commodities, such as banks, for example, because we know we won't invest in these industries. They don't comply with the 10 golden rules. And then we'll have a few other exclusions regarding making sure that the company is expected to grow or has grown in the last 5 years, We'll exclude businesses which have too much debt, as I mentioned, et cetera, et cetera. And we end up with a list of about 500 companies. And then we'll go through that as a team, or we'll allocate a couple of analysts to focus on that. And we'll try and come up every year to a list of our favorites of about 20 companies. And then we'll prioritize these and organize them as throughout the analyst team, basically. Once an analyst is in charge of initiating a new company, we'll meet every 2 weeks with the entire investment team and that analyst. We'll question the company and the progress that the analyst will be doing. So by contacting management, competitors, suppliers, clients as much as possible, and understanding everything about the industry and the company that we can. And we'll try to exclude it. If any time we find it doesn't answer one of the 10 golden rules, we'll exclude it. If after a month or two, it looks like the business is ticks all the boxes, then the analyst will move on and produce a base report. That is 150-page report, which can last say 3 to 6 months to be written. So overall, actually, the process of bringing on a new business in the universe is about 3 to 6 months, depending on how much time you have. So the consequence of that is a very high quality, a very high hurdle, if you want, to enter the universe, and a very low turnover. So the funds have about 20-25% turnover. That depends year on year, but roughly on average over the long run. And that includes a lot of UCITS trading, and that includes inflows and outflows and some trading over the edges, basically. So it's not the true name turnover of the funds. The name turnover of the Seilern universe, on the other hand, is 11%. So that gives an investment horizon of about holding period of 9 years. So it's a very slow-moving universe, and the funds are roughly similar to that. It's a very slow-moving. They're very slow-moving funds, with low turnover. So, just going back maybe here, what's important to understand about all of this is adding a company to the universe first will require the entire investment team to be on board with that. So, a unanimous decision from the investment team, and second. The entire process is valuation agnostic. So we look at valuation. Obviously, there's a part in the base report about valuation. We'll discuss it. But to enter the universe, you don't need to be found to be cheap or expensive or anything like that. That consideration only comes on the second stage, which is the building the portfolios. So you can enter the universe being very expensive, and we'll just wait for an opportunity to buy it into the funds. That means that when we look at the funds and the portfolio construction, so each fund has a portfolio manager, which is a lead portfolio manager, and a second manager, which is a co-manager, if you want. So I'm the lead manager on the American fund. And we often consider ourselves and call ourselves risk managers. I mentioned in the American universe, for example, we have about 30 companies currently in the universe that we can choose. And the portfolio is about 20 names currently. So say it's usually between 20 and 25 names. That leaves very little room to choose between the 30 companies. And what we'll be looking at mostly is valuation and then risks, if you want. So the exposure to different growth drivers, the exposure to different geographies, whether or not, and any kind of risk that we can think of to avoid bulk risk within the portfolio. And on the reward side, we'll look at mostly DCFs as valuation tools and other type of valuations, but we favor discounted cash flow models because we can look at, we can value the business using the cash flows over 5-10 years and beyond that. So it fits our strategy. And so this will be how we'll be building the portfolios mostly, with one person accountable for it. And as risk managers, so focusing on the risk reward of each of the business, which is within the universe. So that should explain pretty much how we operate. And what that means in terms of investing in the Seilern universe. So we have 3 funds, as I mentioned: our global fund, our European fund, and our American fund, which I've been focusing on, which AUM is about $400 million currently. And the AUM of the total fund is just shy of 2 billion euros. The American fund, so this is a slide about the performance of that fund. I won't comment on that performance. I think you all have the numbers. I think most importantly, we try to encourage our clients to look at the long-term performance. We have a long-term investment horizon. And we think, the performance across the cycles of the funds should be the closest to what it should be in the long run, if you want. So that's what we favor. And finally, some statistics about the American fund, which currently has 20 holdings, as I just mentioned. And on the right-hand side, you have about the top 10 positions within the portfolio. And I think on that note, this concludes the presentation. And if you have any questions, just feel free to ask them to Jenny. And Jenny, maybe we have some questions already.
Well, thank you, Corentin. That was very interesting. We do actually have some questions that have come in from the audience. The first one is, how do you use price targets and at what valuation?
Yeah. Well, I think I'll go back probably to the slide about the portfolio construction. So I mentioned that briefly, so we do use price targets, first of all. And I think our favorite valuation method is, and I mentioned that briefly, is the DCF, so the discounted cash flow model. Why? Because if you look at multiples, I think multiples are interesting to see what the market looks like, what the market looks at. Because the market often looks at a multiple, so it says a lot about the stock. So we do that mostly because it's interesting and because it tells us something about the company. But in terms of valuing the business, we think the best way is to value the cash flows of the business, to value what the company generates in cash flow. That's the most tangible way to value a business in the long run. It allows us to capture the growth through 5 years, 10 years, and even beyond that. So most of our DCF are 10 years long. We try to forecast businesses and we try to be conservative, I guess, beyond 5 years because it's hard to forecast. So we try to build a risk margin of error in that sense. And then we can forecast the long-term growth around GDP. So in that sense, we're still, in our view, undervaluing the businesses because hopefully our businesses can grow beyond 10 years above GDP. But that will be the main valuation metric that we use.
Great, thank you. And then another question from our audience. Can you tell me how the fund performed during the volatility earlier this year?
Yeah. I mean, it was a very interesting time, to be honest, for the funds. And I think we're quite happy with how the funds performed, not because of the outperformance, but because they behaved the way they should have. So I think on the way down, when the market really corrected in March, the funds outperformed most of their benchmarks. The reason for that is, as I mentioned, so in a recession or I think there's two phases actually usually in when the market corrects strongly. There's a phase where there's a requirement for liquidity, so a lot of large cap names tend to be sold quite quickly. That will be so often will underperform at the very beginning of a recession because the big names are being sold off as investors basically require the liquidity and will sell what is easiest to sell without too much of a discount. But then later on, as the market continues to correct, businesses which are more leveraged and businesses which are more cyclical tend to underperform, and that's where we'll tend to be outperforming the market, and that's what we saw in the recession. Having said all of that, we didn't manage the funds. We didn't try and manage the funds for this recession. We were all taken aback by the correction in March, just like everyone else. And similarly, but by the recovery in April, May, June, which was very sharp. None of that are things that we can anticipate. And that's why we run the business. That's why we say volatility isn't risk for us. As long as our businesses are not in trouble, as long as they're not leveraged, that's why the importance of leverage. And they can continue to invest in their growth and their cash flows are fine and the leverage is fine, we can just ride these crises, right? So we've done a lot of work on making sure all of our businesses were not too impacted by this, that none of them had leverage above our thresholds or anything like that. And then we just waited. And the performance is good, obviously. But most importantly, we didn't try to fiddle with the portfolio at any time during the crisis. We're just going through the volatility. Yeah.
Great, thank you for that. I think I've just got one time for one more. How often do companies fail to enter your universe that you were telling us about?
Yeah. So I guess I guess the least possible. So I don't have an exact number for that, but where obviously we try to be to have as high a hurdle as possible when welcoming a company into our universe. And so, but on the other hand, we don't want to be spending 2 or 3 or 4 months on a company and then exclude it, right? So we're trying as much as possible early on to exclude businesses, exclude candidates, and move on to the next company so that we don't waste resources. But sometimes, after even a couple of months, the company, looks like it's a good candidate for the universe, and then we find out something speaking to management, or there's a change in strategy that's happened in the past. And so we'll exclude that company and start over again. So sometimes it's a little bit it's challenging because you'll be going through 1, 2, 3 companies and they're just not good enough for the universe. But again, this is where we do the risk management, and this is where the most the hurdle is having the highest quality hurdle is the most important for us, because then that will decide on the quality of the portfolios. And so that's it's very important. But I'd say a couple of every year we exclude from we won't will be candidates, will be studied for a few weeks and won't be entering the universe.
Mm-hmm, mm-hmm. And finally, do you have any view on the outcome of the US election and what either result would indicate for the market?
Yeah. So in terms of views, I don't have much view. I think we try not to take a view too much on the market. I mean, we discuss macro a lot as a team, but we try not to take a view because we wouldn't manage the funds for those views. But in terms of the impact on the portfolio, it should be quite limited one way or the other. We don't have a lot of exposure to industries which would be highly impacted by regulatory changes that would come out of the election, if you want. I think healthcare is often one that's probably quite impacted, and it tends to trade, or the stock and the sector tends to trade quite a lot on the news flow about the elections. But I'd say our exposure is, even though we have quite a bit of exposure to the healthcare market, most of the times regulation wouldn't matter too much. We don't have very high exposure to businesses that depend too much on regulation. We favor medical technologies business, medtech businesses, which have grown mostly from volume growth rather than pricing growth. There tends to be a little bit of price pressure in those industry. And so that means that they're not as exposed to the pharma side, for example, which is a side with a sector we've been avoiding a little bit more because it's hard to forecast, and it's been growing a lot out of pricing, and we think that's probably not sustainable in the long run. So we've been avoiding that one, and that probably gives less exposure to a fund. So we don't expect the funds to have to be strongly impacted by the election either way, whichever way it goes.
Great. Okay, Corentin, thank you so much for your time and for your session.